Taking into account the current market developments and news about world events, investors may forget the basic principles of investing. After all, we are creatures whose decision-making process is greatly influenced by emotions. When markets go up, our fear of missing out makes us buy, and when markets go down, the loss aversion is pushing us to sell. When in reality, we should be happy because stocks are on sale. This is the behavior that leads the market to irrationally price the companies, and it causes the stock to disconnect from corporate fundamentals and financial results. Warren Buffett said it best when he said, "The stock market is the only place where people run when things are on sale." Think about it. If you would go to a store and Coke would be selling at a discount, would you say, "No, I will not buy it. I will rather wait until the sale is over"? Probably not, so why should our behavior be any different when we invest in stocks? But wait, there is one crucial point to make here. The Coca-Cola that is on sale is still the same Coca-Cola that is not on sale. But when we invest, companies can often be correctly discounted. For example, the share price has been too high, and the fall in stock price just means reversion to the mean and correction back towards the fundamentals of the company, which in general the share price should follow in the long run. Or for example, a stock may be on sale because of some news. However, it is entirely possible that this news could have a big impact on the company's overall result, in which case a market reaction may be warranted. So a fall in a stock price does not necessarily mean that the stock is on sale. And investor must be able to distinguish whether the stock is indeed on sale or whether the fundamentals of the company has deteriorated. Basically, Coca-Cola is still the same, but business is evolving and changing all the time. And it is therefore more difficult to determine when it is really on sale. Tip from Warren Buffett number 2. In the world of investing, it is important to know what you are good at and where your strengths are. This concept is known as the circle of competence. The concept of staying within your circle of competence means staying inside the things that you know. Don't go into the world trying to do everything. For example, let's say you often play computer games. You probably have an idea of what games are good, what headsets or keyboards are best for gaming, and generally know a lot of other things about gaming. Does it mean you should go ahead and buy the stock right away? Not really. Just because you are using the products of a company does not necessarily mean that you should buy the stock, but it is a good starting point. Logically, it may be easier for you to look for companies in gaming industry because you already know a lot of things about the industry. When you invest in a gaming keyboard manufacturer, you will probably know very soon if there is a competition on the market that has a better product. Conversely, if you invest in pharmaceutical companies without knowing anything about their business, how will you know that the company's business is doing well and that there is not a company coming along that has a better product? So in general, Warren Buffett recommends sticking with what you know and what you can do. For example, I am a software developer. I know that cloud services like AWS or Azure are extremely helpful. I use both services to create applications, and I know that it can't happen that some company would come out of nowhere with a better product. And even if they did, it would have to be a lot better to motivate me to put in the work and move all of my projects to this competitor. And the third piece of advice from Warren Buffett, which is again directed at retail investors, is as follows.
Some people should not own stocks at all because they just get too upset with price fluctuations. If you're going to do dumb things because your stock goes down, you shouldn't own a stock at all. No, I mean,
what are dumb things? Selling a stock because it goes down? Yeah,
selling a stock because it goes down. I mean,
Warren mentioned in this interview that many people should not buy stocks, especially if they are going to do dumb things when the stock price falls. But in another interview, Warren Buffett offers an alternative for all investors, which is this. Buy an ETF that replicates a major index. Buffett personally recommends an ETF that replicates the S&P 500 index. And forget about owning it. Don't look at the news, don't look at the price, don't look at inflation data, don't look at what Fed is saying, don't look at anything. Go back to that investment in 5, 10, 20, 25, 30 years from now and be happily surprised about the results. Because sometimes you and your emotions are the biggest enemy in your investment decisions. So these were 3 pieces of advice from Warren Buffett going into 2023. Thanks for watching and I'll see you next time.